Hi, my name is John Stevenson, the Guaranteed Retirement Guy. Today, we're going to be talking about how to protect your money from a stock market crash. All right, so you might be retired, you might be close to retirement, maybe you're far away and you're still worried about the stock market. And you're thinking, all right, well, I want to avoid this big market crash that I know is coming at some point. I know it's going to come, right? I just don't know when. Okay. Well, we're going to be talking about that because there are ways to absolutely protect against that and still have decent growth. Okay. Most of the time when you think, all right, well, risk, reward, right? If I risk a lot, I'm going to have higher reward. That is true. But there still are chances to make decent amount of money while protecting at the same time. Okay. So again, my name is John. I'm the Guaranteed Retirement Guy. I deal with guarantees. Okay. I deal with annuities, annuity contracts. Okay. And there's a certain way to set these up. And I'm talking about fixed annuities. I'm talking about indexed annuities. I'm not talking about variable. Because variable annuities, you can lose money. When the market goes down, you will lose money, okay? So I want to look at guarantees. I want to look at market risk. And usually in my videos, I will share my screen and I'll show you everything that's on there and I'll show you different rates of return that are guaranteed versus hypothetical, okay? And I would invite you to go to my channel, The Guaranteed Retirement Guy, and you'll actually see lots of videos where I do share my screen and I show you how to do that specifically. But let's talk about it because I want to kind of talk about how this works, how the annuity contracts will actually save you from a market crash and how they'll also give you growth. Okay. And it's important to set them up correctly. Okay. So that's why I wanted to just kind of have a video where we can talk with each other. Okay. And I want you to know that when I show these contracts, I show everything that's available. Okay. Not just one or two companies that might make me the most commission. Okay. I'm going to show you everything. So if there's something that pays me a third of the commission, you're going to see it. Okay. And that's important because as an advisor, you have to be transparent with people. You got to show people what's available and then you got to kind of guide them. But for me, it's really important that you see that and that you understand that if you do book a call with me and it's a Zoom call, then you will see everything that's available. Okay. So that's what I specialize in. I specialize in annuities. If you want to book a call, there's a link below this video. And if you want to go and book a call on my website, johnstevenson.com, you'll be able to book a call there. You'll also be able to search different annuities available. Okay. You'll be able to see guaranteed rates of return as well. Right now, you've got MYGA contracts. Those are multi-year guaranteed annuities, and they're paying high rates right now, between 5 and 5.5% guaranteed. And you can get that up to 10 years right now. Okay. Maybe you watch this video a couple years after I make it, maybe rates would be back down, but we can still talk about the highest rates available. So, and those are great because they're tied to interest rates. So when interest rates are high, you can lock in a high amount of growth. It's not tied to the market. And if it's non-qualified money, let's say you just pull the money from your brokerage account, it's not in an IRA or 401k, you can put this money into this contract and it'll grow tax deferred, unlike a CD, okay? You can still protect your money in a CD, right? And you can still get decent rates of return, but you will not have that tax deferred growth. You'll have to pay taxes every year. So that's what's nice about a MYGA annuity contract. MYGA is a multi-year guaranteed annuity. You can buy it for a 5-year term, a 6, 7, 8, 9, 10, even 20 years. So that's why it's called that. You got other fixed annuity contracts where you can actually guarantee income for the rest of your life. And those are great. You can get those from a SPIA or a DIA or a QLAC contract, an income rider. Those are great, but they're income products. Okay. That's not something where your principal balance is going to stick around forever. Okay. So that's what you have to remember for those, but they're great for pensions and people are buying them by the billions every year because there is so much income that is produced from these products. And that's why people get them is, when we save, we want usually to use our assets for income. Okay. So again, we're talking about protecting though your assets from a stock market crash. We're not talking about having income right now. Of course, if you want to talk about that, book a call and I'll show you everything that's available for that. So that's it with the MYGA side. With the fixed annuity side, where it's paying you a fixed rate of return and it's compounded every year. There are some that pay simple interest, but most of them are compounded every year. And so it's guaranteed. If you're getting 5.5% compounded every single year for 10 years, that is exactly what you'll get. Okay. If you got $1 million and you put it in there and you don't touch it, you don't strip off any of the earnings or the interest during that time, it's going to grow to over $1.7 million. Okay. Just basic math. It will grow to that. It is an absolute. And then you take your money out and put it somewhere else. Okay. It's that simple. With an indexed annuity, that's a little different. And I wanted to talk about these because people don't understand how can I get the earnings from the stock market without being in the stock market? Well, it's really simple. Insurance companies will spend billions of dollars every single year purchasing call options associated with a particular index. So if it's the S&P 500, they're going to buy call options with that index, okay? And they're going to share some of the earnings with you. Not all of them, but they're going to share some of it, okay? Because there are years where the market is going down. And when the market's going down, they're not making any money. In fact, they're losing because they had to pay for the option that they're not going to exercise, okay? So they're not losing money due to market risk, and neither are you. But they're using those to protect your money against any market crash, because if the market crashes, you're not going to exercise those call options, right? You're just going to let them expire, and you're going to purchase new ones for the next period. That's really how it works. And so when you buy an indexed annuity, let's say you put $100,000 in there and it's tied to the S&P, they might say, we're going to give you up to 8%. Okay, that's the max we'll give you. We'll give you 8% of the index. So the index earns 12, you're still going to get 8, and we'll get 4. That's how that works. If the market goes down one year, you're not going to make anything, but you won't lose anything either. So that's how that works. So it's really straightforward. And in my opinion, if you're going to look at an index annuity, make sure you're putting it into an index that is well known, that's been around for a while. So you got the S&P 500, you got NASDAQ. Okay, you got some different variations of like the PIMCO and Barclay indexes that can work well. Also BlackRock. So there are different indexes, like UBS is a decent index, although it hasn't earned a lot in the last couple of years. It can be good. It's just different variations of it sometimes are only a year old. And when you got indexes like that, they can give you high participation rates, higher cap rates, but they're basing it off of all hypothetical returns that were back tested. And I usually do not recommend those, okay? I like indexes that have been around for a long time, that have proven themselves, and also that credit your account at least once a year. So anyways, things to think about. If you want to protect your money against any market crash and you want to still take advantage of growth, whether it be the absolute growth from a MYGA or from hypothetical but higher growth potential from an index annuity, then book a call with me. There's a link below the video. There's a link on my website, johnstevenson.com, and you can also search MYGA rates directly on my website, and you can also book a call to talk about the fixed index annuities. Okay, so we can talk about that, and we can kind of dive into what you're looking for. And if you're looking for income, you got SPIA, DIA, QLAT, contract. You got calculators on there that will calculate the income, the highest income from all companies, as well as the income rider, which typically gives you the highest payout out of all of those. So, anyways, hope this helps. I just kind of want to make this video a little bit shorter than my other ones, not share my screen, just so we can kind of just communicate with each other. And I hope that you feel comfortable booking a call with me. Okay, if you're looking to purchase an annuity and you're looking for someone who's in your corner, someone who is a financial fiduciary, who is willing to show you everything that's available, that's me. And I would invite you to book a call. So I hope this helps. If you like the video, make sure you like it, subscribe, share it, and you'll get all of the awesome updates every single week, all the new videos that I put out. And look forward to chatting with you on our next call. And until next time, we'll see you soon.